in as they go. Just a little introduction. I am Kelli Muller, and I am one of the directors of client services with Franchise Resource. And although we offer monthly calls with all of our franchisees to go over financials, we thought it would be good to dive a little bit deeper and do a little explaining beyond your financials of just financial statements in general. And so that's where this presentation come in. So a little bit about us. We've been around since 2013, and we work with emerging to mid-sized franchise brands who value the accounting function. They're looking to grow. They want to be successful. And so that's where we come in, to give them consistent, standardized financials and help them along the way. And a few things about us. So we're a dedicated US-based in-house team. So our home base is the Omaha, Nebraska area, but then we work most of us are all throughout Nebraska, Northeast, Southeast Nebraska. We have customized franchise brand solutions. So we work with the franchisor on the brand level to create, customized financials, make sure everything's consistent across the board between the franchise. And then also we're founded by franchisor and franchisees. So not only do we have the bookkeeping and accounting knowledge on our side, but we have our owners have some of the knowledge of what the behind the scenes of franchisor and franchisees looks like. So that's also helpful. Along the way, if any of you guys have questions, you can just type something in the chat and I'll try to get to it either during or at the end based on what it is. But so just feel free to type in the chat if you think of any questions specific to any topic along the way. So the areas that we're going to go over today are the balance sheet and then the profit and loss. And then we'll go a little bit more into fixed versus variable expenses, cash flow and profitability. And then I'll talk a little bit about cash versus accrual basis accounting. So to start off with the balance sheet. So the balance sheet is assets equals liability plus equity. So all of your assets on your balance sheet are going to total all of the liability and the equity sections. And the important thing to note about a balance sheet is that we're reporting as of a specific date on past data. So a profit and loss, you're going to, you can see numbers month by month in totals. Well, a balance sheet is just a rolling balance as of a certain date. So you can look at your balance sheet as of May 31st, or you can look at it as of May 15th. But you're not going to have period totals necessarily like you would with a profit and loss. So here's just a quick example before we go into anything or everything in a little more depth. So here's an example of a balance sheet. We have our total assets, which will break down what current and long-term assets are here. Same thing with liabilities, but you can see your total assets equals total liabilities here. And so to break it down just a little bit more, in general, an asset is something that a company owns. It's a debit or a positive balance. So these are things that you have that have value or people owe you. So some examples of current assets would be cash, like your bank accounts, savings accounts, petty cash, if you have that type of money around. Inventory, so products that you have bought that are going to be of value to you. Accounts receivable, what people owe you. So you've done the work and they owe it to you. So that's an asset. And then prepaid expenses. So prepaid expenses is something that you pay for ahead of time for months into the future. So prepaid insurance, for example, you pay for 12 months at a time. We put that in a prepaid expense, and then we expense it out over the course of the year when we do financials. And then some examples of non-current assets. So you have like long-term investments, patents, buildings, equipment, different vehicles or machinery. There's some tools, larger tools that would be qualified as an asset. And then to go into that a little bit further, so assets are things that you purchase that are over a certain threshold in value that you're then going to capitalize, which means you're going to expense out the cost of that asset over the life of the asset. And so although the IRS, their general guideline is $2,500, is if an asset or something you purchase is over $2,500, you need to capitalize it. But with franchisees, it might be franchise specific. So there are different guidelines with different franchises that they say anything over 600 or 1,000. So although there's the IRS guideline, there's also franchise based guidelines. And so we would kind of adjust based on a franchise as well. And you can kind of set your own guideline as long as you're consistent throughout it. So you can't say 1 month that you have an asset of 2,500 or of 600 that you want to capitalize, in the next one 700 and you want to expense it. So you have to be consistent with what you're doing when you decide to put things into fixed assets. And then going down into the liabilities. So the liability is obviously opposite of the assets. So this is something you owe to somebody. There are credits or a negative balance on your balance sheet. And so an example of a current liability would be, accounts payable. This is things that you owe to vendors, credit cards, things that you charge on your credit card that you owe the credit card company. Payroll expenses or accrued expenses. So payroll, a lot of times on your balance sheet, you can accrue payroll to say at the end of May, I owe my employees this amount of money. And so you're going to pay it in June, the next month. So we consider that a current liability. It's anything that is due within 1 year's time. And so then on the other side of things, and non-current liabilities, that would be anything that is longer than 1 year term. So a lot of times SBA loans, vehicle loans, other loans, deferred tax liabilities, those type of things are going to be in your non-current liability section because those are owed further out than 1 year's time. And then we'll go down in the owner's equity section. So this is anything belonging to the owner of the business after all the liabilities are accounted for. So we're adding up all our assets, we're subtracting all of our liabilities or things that we owe to people. And then the residual, the leftover balance there is the owner's equity. This also takes into effect, there's sometimes owner contributions or distributions. So money that the owner either puts in or takes out of the company. And then also retained earnings. So this is at the end of a fiscal year, your net income or net loss goes into retained earnings. So this is what you retained from a prior year at either a positive or a negative. And so that goes into your equity amount as well. And then as far as your balance sheet goes, there are a lot of different ratios that you can calculate from this. I know a lot of times banks, when you're looking at getting loans, they want to see your balance sheet or any type of credit checks. They want to see your balance sheet. So a couple ratios that are popular are the current ratio, which is really just taking your current assets divided by your current liabilities. And this is just measuring the ability for you to pay off your short-term obligations with your assets. So in this, for this example, if you're less than 1, if your ratio is less than 1, that means you cannot meet the short-term obligations to pay them all off. If it's over 1, that would be a healthier number, meaning that you can pay them off. And then another example would be a debt to equity ratio. So this is the total liabilities divided by the total equity. And so it indicates how much you rely on your borrowed funds versus your owned capital. And so again, there's a number below 2 is considered safe. If you are in specific industries, it sometimes differs between industries. So that goes, you have to take into effect a little bit as well. So just to recap the balance sheet, just like I showed before. So we have our current assets, we have our long-term assets, which is all of our fixed assets. And then also that what is not on here is accumulated depreciation and amortization. And so when I say you want to capitalize an asset, for example, vehicles here, you're going to have the vehicle asset, and then as you expense it off with depreciation on your profit and loss every month or year, depending how your CPA does it, there's also an accumulated depreciation number that will show up here. So that will then decrease the value of your asset. So that will show you the value of your asset as the depreciation or the life of the asset is getting expensed on the profit and loss side. And then we have our current liabilities here, credit cards, accounts payable, customer deposits is another one that I didn't mention. That would be you take money for a deposit, so then you are liable for completing part of their job. So it's a liability to you until you complete that job for this money that you receive from a customer. And then long-term liabilities, we have different loans here, and then your equity section. So you have your retained earnings, which comes over from your net income at the end of the year. And then you have, if you're contributing or drawing money out of the company outside of that, then those can show up on your equity as well. Now I'm going to flip over to the profit and loss side of things. And so on the profit and loss, so this is an outline of your revenue and costs and expenses over a specific period of time. And so, like I said, you can look at this. This is not a rolling balance like the balance sheet is. This is a specific period of time that you're looking at. So you can look at one specific month, you can look at quarters, however you want to look at it, but it can be broken down into periods versus a rolling balance. Here is an example before I go into the different categories of the profit and loss. So your top line or your top item is always going to be your sales or your revenue. And so you can have multiple line items of income, depending how you want to split out your balance sheet or how you're required to split it out. But the top section is always your primary income from your business, whether it's a service or selling product or whatever it is. And then below the income is the cost of goods sold. So these, I'll get into a little bit more in the future slides, but we have the cost of goods sold. We have general expenses here, and then you'll have your extra other income type of expenses are usually at the bottom. So revenue, I kind of hit already. This is your income that you generate from the sale of a good or a service. Cost of goods sold. So these are direct costs that are associated with the delivery of your product or service. So a lot of times these are the raw materials, the labor, things that are directly affecting being able to sell your product or service. And then there below the revenue and cost of goods sold, you'll see a gross profit number. So this is your profit from your revenue less cost of goods sold. This is before any other expenses are taken out of the equation here. And so this is just revenue minus cost of goods sold. Below that, you'll have your operating expenses. So these are everything outside of the materials and labor and items that it takes to produce your service or product. Examples would be rent, utilities, salaries, marketing. Sometimes like sales or manager labor is down in your operating expenses versus the actual labor it takes to produce the product. And so there's sometimes payroll that's down below in the operating expenses. And then once you have all of your operating expenses, so there's net operating income and then there's net income. Net operating income is your profit and loss after deducting all of those extra operating expenses that we just talked about. And then you have your bottom line net income. So sometimes there are the way a profit and loss is set up is there are other expenses or income that are kind of below the line. So these could be interest on your loans. They could be depreciation or amortization. So they're kind of outside of the actual operating expenses, but they're still an expense to your company. So they put those below the normal operating expenses. Miscellaneous income could be if you get credit card rewards or if you get a grant or random money that is not a primary not from your primary business service or type. So again, just to recap, this is a profit and loss example. Just something to note also on the franchise level, a lot of times, or most of the times, the franchisor sets the guideline for where accounts are put on the profit and loss. And so there is on occasion something that as a business owner, you would see that you think is a cost of goods sold and it's down in the operating expenses, but we're a little bit limited there. Oops, excuse me. We're a little bit limited there on moving accounts around. And so if you're a franchisee and see that, you would have to reach out to the franchisor level to see if you can get moved. But we're usually limited on what we can do with changing accounts. To go a little further into the expenses on your profit and loss. So there are things that we would consider fixed expenses and variable expenses. So fixed, those are costs that remain the same regardless of your sales. So you have your rent, you have your insurance, loan payments. Those things are not going to change. If your sales go up, they're going to stay the same. And if your sales go down, they're staying. They're just as they're stated, they're fixed costs. And then on the flip side of that, you have variable costs. So if you have increased sales, your cost of goods sold is likely going to increase, or your payroll might increase because your team is working more hours. Your marketing might be reflective of more sales or less sales. And so the variable costs, they're items that can change based on your sales activity or other things that are going on. Profitability. So the profit is the amount remaining after all your expenses are paid. However, the cash flow is the amount of money that's going in and out of your business. And so there's a little bit of timing difference on how things hit your P&L and when the cash actually leaves your bank. And so some of the cash will flow out of your business, but it's not going to show up on your P&L. Prime example of this is loan payments. So when you make a loan payment, your principal portion of that loan is hitting your balance sheet because it's lowering the liability of the loan. However, the interest portion will hit your profit and loss. So sometimes people will say, you know, I have a great month of sales, yet I'm still losing money, or you know, I don't have as much money in my bank account as I thought. Well, there are things that are hitting your bank account that are not on your profit and loss. Another example would be credit card expenses. So those expenses are hitting your P&L in the month that they hit the credit card, yet you're not paying that credit card off necessarily in the same period. And so when you make a large payment on your credit card, that might be paying for prior month's expenses. And so there's just that difference there of when the cash flows out of your bank to when it actually shows up on your profit and loss. So you just have to keep that in mind when you're looking at cash balance versus what your P&L is showing. And there's typically, I know in QuickBooks for sure, but you can create one as well, like a cash flow statement that kind of lays out your net income and then all of the extras that need to be accounted for to get your cash balance that you have at the end of the month. And then lastly, just to touch on cash versus accrual basis accounting. So cash basis is recording the revenue and the expenses when they hit the bank account. So this doesn't matter if you perform the work in May, if the cash hits in June, that is when the revenue is accounted for. It is when it hits the bank account. Same thing on the expenses. You can get an invoice in May, but if you don't pay it until June, that expense is hitting in June. And so then on the flip side, accrual basis is recording revenue and expenses when they actually incur instead of when the money comes in or goes out. And so from a cash flow standpoint, a cash basis is a better representation of your cash flow. However, accrual basis is the best representation likely of your true profit for the month. So if you want to know your revenue when the work was done and when the expenses hit, that would be accrual basis versus cash basis. And we usually defer to the CPA and how they're going to file your taxes. on if we're reporting on cash or accrual basis for someone. Once you file your taxes a certain way, it has to stay that way, unless you get approval for it to change. But once you file accrual or cash basis one time for your tax return, that's typically how it's filed every year after. So we always kind of defer to the CPA and how they're going to file taxes because they know more about tax laws than we do. And that's everything that I have for you guys today. And so I believe a recording of this video will go out to everybody, whether you attended or not. And so if you have any questions at all, you can email me. You can also go to our website and look around a little bit, find out a little bit more about us. If you have any questions or inquiries, there's a spot on our website as well. But otherwise, I hope everybody has a great day. And like I said, reach out if you have any questions. Thank you.